Sounds good.
Testing, testing. Everyone hear me? Yep, nice. Okay, I'm Lawrence Ray, as you can see up there. I'm a product lead at BitRefill, and today we're going to talk about real-world assets and their tokenization, digitization. Very exciting, I know. And today I'm joined by Nicola Massella.
Hello, I'm Nico. I'm legal partner at Store Partners, Geneva-based consulting firm for blockchain and Web3 companies.
And Edwin Mata.
Hello, everyone. My name is Edwin Mata. I'm the CEO and co-founder of Brigato, tokenization plug and play for the financial instruments being embedded on chain.
And Alessandro Brigato.
Hello, everybody. Thanks for the invitation. It's a pleasure to be here. I'm the CEO of Tokenox, tokenization platform based on Algorand blockchain to manage, store, sign every kind of digital file, and is a product of Blockchain Italia, where I am a project manager. There is a leading Web3 software house in Milan.
And Mohammed Salman.
Hi, everyone. I'm coming from Dubai, chief mate of InvoicePay. We are a decentralized factoring platform, and that's what we'll be expressing how RWAs are basically enabling DeFi investors a new primitive.
So really, just to introduce in this context, real-world assets are, well, they are real-world assets. So you're looking at things like, there's many examples, but gold and oil and houses and watches, and there's various options here. But really, what we're talking about here when we talk about the digital future of real-world assets is we're referring to the process of taking these real assets and then converting the ownership rights into a digital token on a blockchain in most cases. And so this can have multiple benefits, which we'll talk about in a minute. But really, to get us going, guys, the first question I've got here is when it comes to this tokenization process, how does this work? And what are like some large benefits of this, really, at the moment? I think we'll just start with the basics.
I'll jump in. So, I mean, the fact of breaking something kind of makes sense, but it's not the only thing that we have to focus about when we tokenize any kind of asset, right? So breaking something into tokens and facilitating the transaction between parties is one of the characteristics, but we also have to think about like the less intermediaries into the process. So if I have a financial instrument, we in equity debt, and I want to capitalize myself, what I want to do is be as lean as possible to get to my capital objective. With blockchain, you can go directly from issuer to investor, and then also with the asset settlement. So less transactional fees are being between the issuer and the investors, so more capital is gained. Cross-border capitalization. It's not so easy to get capitalized in the same like region maybe, but when you go abroad between continents, it gets complicated. So all the characteristics of the blockchain of how it was built, if you embed that into a financial instrument, what you have is optimization and efficiency. So I think during the past year, we've seen kind of like the marketing scheme saying it's about democratization. It's just a single part of the whole process and the goods that actually tokenizing financial instruments on chain can bring.
Cheers. I mean, I think like, did you mention because I can't hear you too well, but did you mention basically the increase in liquidity, I think it was that you mentioned then?
I didn't, but
yeah.
All of these characteristics, just by tokenizing something, you don't make something liquid. You make liquid something by accessibility.
Right.
So the more accessibility and the more barriers you break, the asset by itself become more liquid. It's not by default that tokenizing liquidity gets embedded. It's by how easy it is for somebody to start investing into the asset, to start transacting, how much capital you start making it more wider to a wider range of possible investors. That is where you can start generating liquidity. But liquidity by default does not come on the tokenization layer.
Gotcha, okay, yeah. So essentially, yeah, this is like the first step. You still have the hard work after to actually get people interested and things like that. Oh, Mohammed, please.
I'll just add to it, everything evolves, and assets are also evolving now. It's an age of digitization. So tokenization of assets are basically just a new evolution for the assets. More access, more liquidity, more, like again, different revenue streams coming out of those assets. Access simply, it's not just available for one geographic location, it's global now, 24/7. Tokenization is normally associated with fractionalization, I agree. So yeah, again, this is just one of the features which is enabled for the assets, for like gold and other bonds and other things. So It's just a new iteration or new evolution for the assets with more features powered by the blockchain, which is a technology.
Gotcha. When you mention fractalization, are you talking about, so for example, if I have a house, you could potentially tokenize it and then have 10 different owners of the house quite easily, rather than in a traditional sense, it becomes quite difficult.
10 or even 10,000. So this is generally like you need to buy something big. You generally offer it to the pool of people. Let's say even if you want to get investment for a company, you offer it on a share basis in the different exchanges. So now with this token thing, you can raise investment, you can fractionalize or divide your asset, a bigger asset, into smaller chunks. Offer not just the let's say yield at the same time, staking offers more yield as well, and in the long run that asset is growing with its valuation, and of course you are also being a fractional owner. You can pass it to others on different channels. So this is a big, as I said, evolution. It's just one of the features.
Gotcha. I think one thing that I was going to ask is, say for example, I or anyone out here, say we want to tokenize something that we're selling, right? Whether it be coffee we're selling or apartment buildings or whatever. I know, Nicola, we spoke briefly about this earlier. How would you go about doing that? Like, I remember you mentioned that, okay, you'd potentially set up a company and then they'd buy. Like, if you could talk us through that process, that would be helpful.
There are
many
different ways,
yeah,
exactly. Yeah. So indeed, actually, when you say, let's say, what is tokenization? For me, being a lawyer, like it's a very specific thing. It's attaching a set of rights to a token. This is tokenization for me. And this set of rights can be of a different nature. So for instance, if you tokenize real estate, one very practical way is to allocate the real estate assets inside an SPV, like a company that has really this purpose, and then you tokenize the shares of the company, and you sell these shares. Or you could even do it in different ways. We did it for a client of mine. Basically, there was this SPV that was issuing not his shares, but bonds. And these bonds had basically guarantee over the real estate, and they were paying out a coupon, and the amount of the coupon was variable based on the performance of the underlying real estate assets. So depending on the rents and the proceeds generated by the real estate assets, the coupon was varying in a fork depending on certain percentages and KPIs. I think that was a very clever way as well. And then there is the direct tokenization. So when you really have tokens, even NFTs more commonly, that are certificates of ownership of a certain asset, and this works well when you tokenize, I don't know, luxury watches or diamonds or these kind of things. And then the token is really just a certificate of ownership that proves that basically you can go to the custodian and claim your asset by delivering the certificate. So these are just some ways in which you can do that.
Gotcha. Okay. No, thanks. I think, I mean, obviously you're a lawyer here, so maybe you're the best one, but I'll ask everyone here. I mean, like, there's got to be, what are the kind of regulatory and legal hurdles that you might come across when you're working in this side of the industry? Because, like, imagine there's many, right? Different countries, different assets being tokenized.
Well, yeah, there are many. In particular, if you speak about real estate tokenization, that's a complex one. Like, tokenizing directly the real estate assets is almost impossible. In every country, the transfer of real estate is highly regulated. You often need a notary, and you need public registers and so on. So it's not feasible to have the real estate assets tokenized, and then you have 1,000 owners, and they should all register in the registry. So you need something in between, like a company. And then the other kind of incongruencies in tokenization is the nature of the token that you are going to create. So when you tokenize through an SPV and you're tokenizing the shares, that's a security token, because those are shares that are tokenized. Instead, when you tokenize watches or diamonds or these kind of things, this thing of the certificate of ownership is often a bit of a it's a bit of a gray area, but often it's not a security token. At least in Switzerland, it's not a security token. It's just a certificate that you can then redeem. So from a regulatory point of view, I think that the biggest risk is just the uncertainty. But once you have a solid legal setup and you can provide to your users, then I think you're set to go.
You're good to go. Okay. And I think, like, so obviously with us being in the EU right now, and I know there's probably a lot of people here listening who live or work in the EU, when it comes to regulatory framework here, in the EU. How is that looking right now? How is that changing? I mean, I'm interested into, because I've heard about real-world asset tokenization for a while, and I'm kind of just wondering, like, why should I be interested now, right? And is there like regulatory benefit right now? Is it developing, or what's the situation, I guess, with MiCA and things like that?
Well, MiCA doesn't really concern tokenization. It concerns it only when it talks about asset reference tokens that are tokens backed by real-world assets, like, I don't know, a commodity like gold or silver and so on. So definitely there is a development in this area, but you have to remember that MiCA is a quite old regulation, because even though the last part will enter into force only at the end of this year, it was drafted many years ago. So a lot of things that we see now in the market are not really there. But you don't, I think if Switzerland kind of brings a message to the world, is that you don't necessarily need new laws, new regulations to face this kind of things. You can adapt the existing ones to even fit with these new purposes.
Gotcha, okay. And I know, Mohammed, like one thing I wanted to ask you about, we're obviously talking about here real estate, and we've talked about gold and touched on some of these things, but I know that your sort of use of real-world asset tokenization is a little bit different, working like invoicing and stuff, so I wanted to understand that a bit better.
We have a very different take on real-world assets, and it's basically the real-world revenue that sits on the asset sides of the balance sheet in the bookkeeping. So it's a bit complex, but anyways, it's the unpaid invoices or unpaid trade receivables. That is an asset. Not many people do know about that. They can use it as a collateral to get lending from financing institutions. We are bringing it to the Web3 world, and with the DeFi, decentralized factoring, we are bringing it to the retail investors as well of Web3. Now they have a choice. They have these dual asset liquidity pools which are keeping the highly volatile collaterals like Bitcoin, Ethereum, and they also have now opportunity to invest into these real world revenues of the real world businesses. So now it's an actual real world asset. Of course, the other side, the Bitcoins are also asset, and Ethereums, but they have this dual asset liquidity pool issue, volatility and a loss prone. We cover that part with the stable yield coming from the real world revenue, unpaid invoice receivable of real world businesses. So SMEs get benefit out of that. They have these inefficient invoice receivables. Now they can go for an alternate finance. Instead of banks, instead of financing institutions of Web 2, they also have now a reach to the Web 3 investors who can buy out their receivables.
So I might be oversimplifying a bit, but is it in a sense, again, maybe oversimplifying, but is it in a sense kind of tokenizing the debt that a business has on its balance sheet in a way, or have I misunderstood?
Tokenizing not the debt, tokenizing the receivable.
Right, okay.
So debt is that which is difficult part, so if it is going to be covered or not, but the receivable part is certain to be, it's sitting on the asset side, not on the liability side. Debt sits on the liability side, so it won't be called as an asset. So in receivable, which is an actual asset sitting on the balance sheet on the asset side, so that's why it's more like it can be tokenized and can be used as a collateral for the lending and borrowing proposition.
Understood. No, that makes sense. I appreciate it. And I think, yeah, there's obviously you've got the legal side, you've got the invoice side, which is obviously very different. And I guess more a question probably for Edwin and Alessandro, but obviously, Alessandro, I know you work with kind of like providing like a portal for people to be able to tokenize assets. What's like some of the, I guess, the biggest opportunities you're seeing now? Like, what are the industries or assets that you're seeing that people are really starting to look at tokenizing? And where do you think there's like a big opportunity for people to start tokenizing and investing?
So, the colleagues, the other speakers gave an overview on different aspects, legal, different fields like luxury watch, real estate, and so on. So I would like just to have a zoom out and why we should tokenize everything, because we can introduce a layer, the blockchain layer, in every kind of digital asset. So we can improve the digital workflows or the digital processes in every kind of digital process. That help us to digitize processes that now are analogic and introduce blockchain in processes where we have many third parties or different bodies. So it's like a layer of transparency between them. Every process that we analyze with the company often has different layers. So you have maybe the payroll company, and then you have the institution layer, and you have many parties that took part on a process. Maybe could be a bachelor, could be a degree, could be a credit payment title, everything. And if you want to tokenize them, you have more transparency between every part of the process. So it's the first step. So why don't tokenize everything? That's the question. There is not many effort. It's easy to tokenize. The problem is which kind of blockchain, which kind of asset, how can we guarantee the value? For example, Nicola said that in many cases we have a bunch of deals, so a bunch of contracts that we have tokenized as warranty of, for example, a real estate, because you cannot tokenize, you cannot have many owners for one building. So you can, but it's another kind of contract. And you tokenize the right to have an yield from that token, to participate to the revenue, to trade your token related to that what the Oracle says, because it's not on-chain digital asset, but it's a real estate, so you have to follow the market. You can do that like Bitcoin. Bitcoin is a digital asset on-chain, and you can track with Bitcoin is not Ethereum, but with the exchanges, with the trades, and so on, or for Ethereum, for example, with the DeFi, with the automated market maker. So you need something that give you a value, like an oracle from the real world, or you need someone that has maybe the luxury watch as in a value. So you have different steps, and then the other one is the interoperability. If you start to tokenize, you give transparency, you improve the digital workflow, the processes, and you have a token for everything. So the first application could be, I have to sign a contract. Why don't in the blockchain field, with maybe with the Audi wallet, or with the digital identity recognition, or other stuffs, could be the digital blockchain ID. We know many digital ID that could be reusable or KYC. And the second step is interoperability. We have many logics in the DeFi space and in the blockchain space where we can maybe having a share of company or having a share of real estate, we can collateralize or over-collateralize that quote, that share, for having a loan. It's something you already said, that we are going to make liquid a market that is normally and generally liquid, and we have financial benefits and financial perks, access to unbanked people, and we can approach targets that are outside from financial space with just maybe, you talk about luxury watches. I see that Audemars Piguet, Rolex, and so on are going trend, and there is an hype, and maybe I can do 20% of yield APY, but I cannot afford 30,000 for a watch, 50,000 for a watch, but I can diversify my wallet with 2,000 in Audemars Piguet, 3,000 in a real estate in Miami, 2,000 in a piece of art, and so maybe even with a small amount, 10,000, 5,000, 500 euros, I can start to invest. And as it's never been before.
Yeah, I mean, I think that makes a hell of a lot of sense, right? And I think I understand pretty well, fairly like the process of how to do this in many cases, not all, and also the benefits, which obviously you've stated a fair few there. But I guess one of the things that comes to mind right now to me is, okay, say I want to do this, I've got something I want to sell, for example, and I want to gain like a larger, market that I can market to and obviously get buyers from. What are because I'm thinking of the risks, right? Like, what are the various like risk vectors, and what kind of risk management are you guys doing? Because, and what are like the weak areas, I suppose, that you're working on essentially trying to reduce risk in? Like, could it be the oracle as a kind of point of failure or an attack vector, or could it be? I mean, one of the things that comes to mind for me is like, okay, say I want to tokenize, say I have a house and I want to tokenize it and sell it. I have to at least somewhat trust someone there, right? Like whether it's the company that's doing the tokenization or storing the deed or whatever it may be.
Yes, the main risk is related to the code. Even most of the tokenized assets are based on a smart contract. Not all. For example, we tokenize it on Algorand. There are native assets, so they don't need smart contract. But every smart contract has a point of failure. Based on the contract, on the standards. There are different standards on Ethereum. The ERC are many. There is ERC20 for fungible token, ERC 721, 1155, 3643 for the real world asset. So we have a community that has continued to build different standards and solve the existing needs. So, but we have a point of failure. The other point of failure, of course, could be the oracles, the market, the liquidity, because I think the point of failure is I talk about interoperability, but we have different blockchain and different solutions. So one of, but not just for the real world asset, one of the obstacles we had is the interoperability and the cross-chain technology. Now we are trying to have, we have a lot of multi-chain solution and a bunch of cross-chain solution because the time of the trades sometimes are long and are complex because you have many smart contracts that they has to interact between each other. And so there are some point of failure, but there is not just the monetization and the tradability of this token. The first point, I think, is the tokenization of the asset. And I think there are not many points of failure in that, because you're just going to tokenize maybe a PDF or a file. And so you have a proof of existence of that file, a proof of immutability, proof of paternity, because you have a wallet connected to your digital identity. And you can add different, now maybe when we talk about in a blockchain space, we are used to talk about different silos, blockchain, AI, IoT, and zero knowledge proof, and so on. But I think the merge of these technologies can give us an opportunity, because you can have a digital identity based on zero knowledge proof. You can interact with the blockchain with your wallet, and maybe it's connected to a IoT wallet for the institution issues, or without KYC if you want to stay in the Web3 and you want to be anonymous. So there is some issues. The most one is the legal framework. The most important one is the legal framework. We have to have a standard for digital identity, first of all, and which blockchain we should use. Because when we talk about blockchain, we build on Algorand, Ethereum, Solana, and so on, but maybe we talk with the European Commission and they ask to use Hyperledger Bezos, so Hyperledger like a permission. And so, which is the limits are related to the technology? I don't think so. We also have solution for decentralized storage and so on, the PIN structure. The problem is the institution could understand which is the technology that we can provide to them, and we have to talk with them to create a right balance between the technology that we already that we currently use, like cloud, and the technology that we should use, like decentralized storage, the PIN, and so on.
Yeah, and I understand that like every blockchain and every use case kind of differs, right, when it comes to the benefits and downsides. I don't know, like what are you guys seeing as like maybe the one or two like emerging most popular blockchains for like real world asset token? What are the two main ones that you would see that are emerging for when it comes to real world asset tokenization?
I would really like to answer that. None. Why is that? Because the Web2 client, which is a financial institution, the real estate company, they could care less about the chain. They just want the user experience that can onboard them, their investors, the capital. So the point of failure is not on the tech side. It's always on the offline. How are you going to digitize the value? Where is your trust foundation? Are you audited or not? Are you embedding that on chain? Because the only thing that matters is the transaction value, right? So the chain is what they've been telling us from the blockchain. Oh yeah, my chain has TPS, we have so many wallets, and then you go in and it's all ghosts. The only thing that matters is, can I embed my financial instrument, real world asset, whatever, online? Because they don't even care about the blockchain. They will never ask about all of that. So it is the duty of us, the tokenizers in whatever format, to provide a great user experience, abstracting the wallet, Google sign in, Facebook sign in, LinkedIn sign in, I don't care, email sign in, abstracting the payment. Why would you pay twice? Gas fee, they don't know what's a gas. The local USDC, so many chains, so many USDC, you have to abstract that. And the asset, the receivement. I just want to know where I can enter into a dashboard. I know that my asset is there. If you abstract all of that, then blockchain just becomes a back end, which was absolutely what we were always going for. Blockchain as a selling point has been a big fail, but people keep selling blockchain as the main point. Ask outside of here, of this group, what is the difference between Ethereum and Solana? I will say Rust. Oh yeah, the language. But the rest, they wouldn't even know.
No, that's a fairly good point to make.
I'll 100% echo Edwin that yes, a lot of people miss out the Web 2 element in the RWA space, because you are interacting on one side at least with the real world, which is, to be honest, it's not even Bitcoin is a real world, but degens are real world, the DeFi investors are real world, but we call real world the Web 2 side. So Web 2 side doesn't know the Web 3. There is a lot of education required to bridge this gap. Otherwise, this real world asset tokenization will be a dream. The mass adoption will surely be a dream. You need to educate the both sides. You asked about the risk earlier. Risks with the assets is always going to be the fraud element. Whether invoices receivable, whether real estate, whether you talk about gold, diamond, whatever. Fraud is the biggest risk in this business, or in this kind of a genre. So you have to have a very good due diligence. You have to have a very good, like again, a proper business approach rather than tokenization approach. Many projects come every day for tokenizing X, tokenizing Y, tokenizing Z, but they are missing out the business element of it. Tokenization is the easiest part in this business. The difficult part is the off-chain, you can say, the part of the business, which is the real business.
Yeah.
Gotcha. Yeah, no, I get your point. So it's really, yeah, as you say, like tokenizing, I mean, you guys have got that covered. It's pretty simple at this point, but it's more about the trust, the marketing, I guess, like with a lot of things in cryptocurrency that I feel like we're kind of missing out on a little bit, is like making it easy. Almost, dare I say, make it boring. Like, my brother uses his credit card. He doesn't give a damn who settles or why or what bank or whatever. He doesn't care. And so, like, I guess you really want it to become boring, really. Like, oh, I just use this because it's easy, and I just tokenize this, and boom, away I go, and I get money from people, and it's just a nice, easy experience. Yeah, so that, it feels like, I guess, well, I mean, it feels like that's one of the main challenges, I guess, that are being faced by everyone here outside of the legal side.
It needs to become more easy, for sure. But also consider the timing. I mean, we are still kind of at the start, and yes, I think, as Edwin said, there is a lot of, let's say, little understanding of the different technologies that run through it, even in people that are, let's say, passionate about crypto and so on. But I think with time, it can come. And now I see, because I see the projects of my clients, a lot of projects in which basically you don't need to have any prior knowledge about blockchain technology or anything to just use the app and purchase and so on. You basically just need to press connect wallet, and then it's done.
It gets done. Gotcha. Okay. Well, I mean, yeah. I guess, yeah, that is really the future for most cryptocurrency and blockchain technology companies, right? Is to, in most cases, whether it's B2B or B2C, make it so that you don't have to know about how the tokenizing necessarily works or why you've chose this chain or whatever. You do your thing, whether it be selling houses or storing gold or painting selling, and we'll do our thing, which is the blockchain, the technology side, and so then, yeah, they'll obviously have to trust in you guys, but I mean, every business has to do that in most cases with most partnerships, so it makes a lot of sense. Okay, well, I think realistically we're running pretty close to the end of the talk, so it's probably a good time to wrap it up. But guys, like, I appreciate it. I feel like I've learned a fairly good amount, to be honest. Like, I came into this knowing the basics, asking the dumb questions, Yeah, I feel like I've kind of learned a bit, and I want to chat to you guys as well further on from here more about this and how like crazy use cases I can come up with and maybe make me $1 million in the future. But thanks, Mohammed. Thank you, Edwin and Alessandro and Nicola. It's been amazing to talk. And thanks to everyone for listening to us yap on together for the last half an hour. I appreciate it.
Thank you.
Take care, everyone.
Thank you.